All right, so let's get into this. A deep dive is on, and you send over a whole stack of material focusing on Solana, SOL. And I think for anyone watching the market right now, the context is, well, it's pretty rough.
That context is everything. The current narrative is, frankly, painful.
Yeah.
You're looking at a crypto that's down nearly 30% this year. Its all-time high was back in January of 2025, around $294. And now it's trading about 55% below that. It's hovering near the $124 level. So right now, this is a recovery story, not a growth story. Not yet.
Exactly. And the sentiment is, disappointment. But the research you sent outlines these three huge interconnected catalysts that look like they're set to converge almost surgically in early January 2026. So our mission today is to pull apart these three pillars. We're talking a regulatory shift, a huge tech overhaul, and then these two big liquidity events. We need to see how this could redefine Solana entirely.
It's a foundational inflection point. I mean, for the last couple of years, Solana has been all about what you call speculative retail momentum.
Right.
But this convergence in January, it shifts the system toward what we call institutional structural integration. If these things hit as scheduled, the whole story changes from a risky bet to necessary infrastructure.
Okay, let's unpack that, starting with the first one, the regulatory green light from Washington. This feels like the big one, the policy risk that just has to be settled. We saw all this progress over the summer on crypto legislation, and then it just stalled out, especially after the government shut down.
It felt like two steps forward, one giant leap back.
Yeah.
And that absolutely killed the institutional mood. You have to remember, these big firms don't need the government to, endorse crypto.
They just need rules.
They just need clear lines, certainty. And the key piece of legislation here is the Digital Asset Market Clarity Act, H.R. 3633.
Okay, so that bill passed the House back in July, which was a big deal. But the sources you sent all point to the Senate committee markup in January 2026 as the real trigger. Why is a procedural step like that the institutional so what?
Because it's all about settling the turf war. The main goal of the Clarity Act is to finally resolve this long-running fight between the SEC and the CFTC.
The Securities and Exchange Commission and the Commodity Futures Trading Commission.
Right. The bill wants to define once and for all which digital assets are commodities, like gold, and which are securities, like stocks.
So the big money isn't just waiting for a price signal. They're literally waiting for a legal definition so they know who they're reporting to.
Precisely. This regulatory clarity is a massive de-risking event. Institutions need auditability. They need a known legal status before they can allocate serious capital.
And you have big firms already lining up for this?
Oh yeah, Grayscale, VanEck, they're already pursuing spot SOL ETFs. But this ambiguity is the single biggest barrier. You can't launch a regulated product if no one agrees on how the underlying asset is regulated.
So if this framework passes, the U.S. starts to catch up with Europe and their MiCA framework.
That's the consensus, yes. If it doesn't pass, the U.S. capital markets fall further behind. And you can't forget what the Federal Reserve is doing at the same time.
The proposal for payment accounts.
Correct, which is all about banking access.
Right.
This would let fintech and crypto companies access central banking rails directly for the first time. For Solana, which is already a massive stablecoin hub, we're talking $16 billion. That's huge.
It just removes friction.
It removes friction and solidifies its role as a global payments layer. The whole regulatory push is about building that solid foundation.
Okay, so if that's the confidence layer, let's talk about the engine. The technology that actually has to justify that confidence. This is where it gets really interesting for me. Solana's had this reputation, right? Fast, but fragile. Outages that really hurt trust. The sources say these core engineering breakthroughs are changing that whole story.
This is the argument for why the network can actually handle institutional-grade flows when they arrive. The first catalyst is Firedancer.
Firedancer. Break that down for us. What is it in simple terms?
It's basically a complete heart transplant for the network. Historically, Solana ran on one main software program, one client.
And if that one program had a bug?
The whole network could go down. A single point of failure. It's like if the entire global banking system ran on one brand of server.
Which is exactly what led to those outages we saw.
Exactly. Firedancer is a brand new independent client developed by Jump Crypto. It's a total rewrite, so it gives you validator diversity. A separate system running in parallel. If the original client fails, Firedancer keeps the lights on.
That's the resilience piece. What about the speed?
That's the other half. It's targeting a theoretical ceiling of 1 million transactions per second in controlled tests.
1 million TPS. That number gets thrown around a lot. What does that kind of throughput actually feel like for a user or for the market?
I mean, we're talking about a decentralized network that could handle the combined volume of Visa, MasterCard, and probably the New York Stock Exchange, all at the same time, on one layer.
That's why they call it the Holy Grail.
It is. Latency just stops being a limiting factor. And this isn't just theory. The rollout started in late 2025. Over 20% of validators are already using the hybrid version, Firedancer. It's happening now.
So Firedancer handles speed and fragility. But a fast transaction isn't useful if you have to wait forever for it to be final, to be irreversible. That's Alpenglow, right?
That is the finality fix. Alpenglow is a consensus upgrade scheduled for early 2026. Finality is the time until your transaction is locked in, permanent, can't be reversed. Today, Solana is already fast, around 12.8 seconds.
Which is faster than swiping your credit card.
It is. But Alpenglow aims to get that down to an industry-leading 100 to 150 milliseconds.
Whoa, so you're going from waiting a few seconds to basically instantaneous, high-frequency trading speed.
That's the goal. It does this by streamlining how validators vote and by using dynamic block scaling. So instead of a static speed limit, the network can ramp up based on how powerful the hardware is. It removes the bottleneck.
And that 150 millisecond speed, that really gets at the core architectural difference between Solana and, say, Ethereum.
It does. It's the heart of the whole debate. Solana is monolithic. It scales everything: speed, finality, execution, all on its main layer 1 chain.
Whereas Ethereum is going modular.
A roll-up-centric roadmap relying on all these separate layer 2 networks to handle the bulk of the work.
Why does that distinction matter so much to institutional capital?
Because for something like high-frequency trading, you need guaranteed low latency and security on the main settlement layer. Using a layer 2 rollup introduces new risks: bridging risk, execution risk. Solana's strategy of putting that sub-second speed right on layer 1 is what lets you build those reliable HFT rails directly on-chain.
Okay, so we have regulatory clarity and institutional-grade tech potentially arriving in January. Let's get to the third driver. The raw influx of capital and adoption. The ecosystem liquidity events. We know the ecosystem is already strong, almost $3 billion in revenue over the last year, about 10% of the DeFi market, often beats Ethereum in daily trading volume. What are these two big January events?
They're very calculated moves to deepen engagement. The first is the Solana Mobile SKR token launch. SKR is the native token for the whole Solana mobile ecosystem, built around that second-gen Seeker smartphone.
And they've shipped over 150,000 of those phones, directly tying hardware to crypto incentives.
Precisely. The launch is set for January 2026. And the key detail is the airdrop. Of the 10 billion total tokens, a massive 30%, that's 3 billion tokens, is being airdropped exclusively to people who own the Seeker phone.
That's a huge incentive to actually own the hardware and use their dApp store.
Especially since developers keep 100% of the revenue there, completely undercutting Apple and Google.
They're using the token to drive real-world adoption. But they also introduced this concept of guardians for the mobile ecosystem. Wait, what is a guardian in this context? Why does a phone need one?
It's about security and authenticity on the mobile dApp store. SKR holders delegate their tokens to these guardians, think major players like Jito or Helios. And these guardians are responsible for verifying that the apps are legit, using something called a TPIN framework.
TPIN framework. Okay, that's a bit of jargon. What's the simple version?
It stands for Trusted Execution Environment Protected Interprocess Node. But really, think of the trusted execution environment as a locked digital vault built into the phone's chip. The guardians just verify that the apps are legitimate and can't tamper with what's inside that vault.
So it makes sure the dApp store is safe, which is critical if your phone holds your money.
Exactly.
Now, speaking of chips and security, your sources had a very concerning note about the Seeker phone itself.
It did. It's an important balancing note you have to be aware of. The second-gen Seeker uses a MediaTek Dimensity 7300 chip. And security researchers from Ledger found an unfixable hardware vulnerability in that chip.
An unfixable hardware vulnerability. That sounds catastrophic. Does that just kill the whole mobile strategy?
It's serious, but the sources give important context. The flaw lets an attacker bypass the chip's protection with electromagnetic pulses, but only during the initial startup of the phone. The material notes that the odds of a successful targeted attack are extremely low, between 0.1% and 1%. So you, the listener, need to know this risk exists. It is a fundamental flaw in the hardware, but the probability is low.
Okay, low probability but high impact. That's a crucial detail. Let's shift to the second liquidity injection, Jupiter's Jupiter airdrop. Jupiter is the biggest DEX aggregator on Solana.
Right, and their JUP token airdrops are always major market events. For January 2026, they made a big strategic change. They capped the immediate airdrop at 200 million JUP.
Wait, down from 700 million JUP that was originally planned for that wave?
Exactly, a huge cut.
Why would they do that? Doesn't that just kill the hype and alienate users who are expecting more?
That was the risk, but the rationale was very specific. They wanted to mitigate the dilution and the massive selling pressure they saw in past airdrops, where speculators would just dump their tokens immediately.
So they're changing who they reward.
They're rewarding long-term value. This time, eligibility is restricted only to fee-paying users, people who actually use Jupiter for swaps, for perps, for lending. The snapshot is January 30th.
So active users, not just farmers.
Correct. And to push people to hold, there's a separate 200 million JUP bonus pool just for recipients who stake their airdrop tokens. The signal is clear. We want participants, not sellers.
So what does this all mean? You pull these three threads together, you have legislative clarity, radical new tech speed, and these two big calculated liquidity injections. How does this all converge?
It means Solana enters January 2026 with this unprecedented combination of strength. It de-risks the asset for huge pools of capital. You have a political environment ready for a decision, you have the institutional grade tech, and you have these events injecting sticky liquidity while reinforcing real adoption.
Then what does that mean for valuation, based on the models in your sources?
Well, the asset enters January at a technical crossroads for sure. There's strong support noted around $116.88. But when the models factor in these three catalysts, the algorithmic consensus points to an average price target of around $235 for January 2026.
And the bull case.
The most bullish fundamental targets actually go past $300. That puts it right back in the conversation to challenge its old all-time high of $294.
We have to touch on the one shadow still hanging over Solana. The supply from the FTX and Alameda bankruptcies. That fear of a market overhang, how real is that risk now?
The fear is that court-ordered sales could just flood the market, and that risk still exists. There's about 636,985 SOL scheduled for release in January 2026.
Okay.
But analysts point to two things. First, that number is a smaller and smaller percentage of the total supply. And second, it's largely offset by the incredibly high staking participation on the network, which is offering 5 to 7% APY and locking up a huge portion of the supply.
So at the end of the day, the narrative shifts from a simple recovery to a fight for the top spot.
It absolutely does. The central conflict of 2026 seems to be this: Solana's monolithic approach versus Ethereum's modular approach. So you have to ask yourself, as this internet of capital markets develops and it demands global scale, instant settlement, and the institutional confidence that comes from clarity and uptime, which architecture will ultimately prove more resilient and more attractive for that sophisticated high-value capital? That's the huge, bigger picture question that all of these January catalysts are trying to answer.